Hi all, I'm Sham and I have Kishan with me.
Hi, Sham.
Welcome to Free Float. This week, we are just going to give our readers and viewers the lay of the land when it comes to ETFs listed in the US. Now, a lot of Indian investors are also looking to invest in US listed stocks and ETFs. And more often than not, they're also getting caught up in the in the social media driven trading frenzy that is sweeping the US. And more often than not, they end up investing in some either meme stocks or IPOs, or the same mistakes that they do um, when they invest domestically. So just because they have shifted the focus to the US does not mean that the old habits have been overcome. So this is our attempt at saying that, look, if you're planning for a specific goal in mind 10, 15 years down the line, right, it makes no sense for you to try and do some whack-a-mole in the US, especially in the US where markets are extremely efficient. So even billionaire fund managers fail to beat the index. And a 60-40 allocation is pretty much all you would need, if you're trying to do something with that cash 10 years down the line. And so what we have done is listed a dozen ETFs, and it covers most of the important asset classes, and it kind of plays to the advantage of investing to US ETFs, which is they cover a very broad array of assets. So it can be US equities, European equities, or emerging market equities, or bonds, and real estate, or commodities. So they have over 2,500 ETFs, and they cover pretty much every asset known to man and woman. So it's one of the biggest advantages there, and it will be tragic if investors don't take um, the full benefit of investing in the US, and go do the same things that they used to do when they invest in India. And and I hope that this list of ETFs also benefit US investors. And if they're just starting out and they're looking to build a retirement portfolio, most advisors will not uh, solicit them, will not take the business because the funds are too low. So this is a good way of getting started, and hope it helps people who are already in the US and looking to invest as well. So Kishan, do you want to sort of
Yeah.
take this away?
Yeah. So, Sham, I for one, I'm like fascinated by all. I mean, the kinds of the kinds of ETFs that you get in the US, right? So in India, even like the Nifty 50 index, ETF has no volume. You know, it would be trading at some insane, at some insane divergence sometimes that and no volume, and you get probably some index fund. Only like Nifty 50, maybe you get an ETF. You wouldn't get a NSE 500 ETF, or like an NSE Auto ETF, something like that. So, and in the US, I see, for example, I'm fascinated by this psychedelic ETF, which invests in stocks where there's medical research of medical companies that are like researching psychedelics for uh, mental illness and stuff. So you find ETFs for like any theme that you can think of, like, and it's not like a theme like, like we see in small case, where you see housing theme, and you see cement stocks, and I mean, you see the same stocks in different portfolios, but I mean, which says it's a new theme, but it's the same stocks. You see really unique companies, and you see really unique ideas and stuff. So I really like that. But when you're talking about 2,500, like ETFs, and in this vast variety, how do you go about selecting them? So if someone wants to invest.
Right. So you mentioned psychedelics and like that. There are pot ETFs, there are lithium ETFs. For a while there was a uranium ETF as well. So it has like some 3 or 4 stocks. So
Yeah.
so the idea here is, there are so in the US the biggest, I would say, it's not really a problem, but everything there is extremely business oriented, right? So if there's money to be made, rest assured there are people making that money, and there are all these ETF platforms that give you, sort of like issue ETFs as a service kind of a business, right? So if you have a good idea, and if you think that it can garner about $10 million in assets, you can go to them and say, create this ETF for me. So what they will do is they will hire an ETF index provider, who is cheap enough to to kind of meet your thing. So we're not talking about MSCI or Barclays or Bloomberg,
Yeah.
or it's some rinky-dink index provider who has registered with the SEC, right? He could be anybody, and it could be anybody, and and then they will go and create a trust for you, and they will be the shadow advisor, and then or the shadow promoter, however that whatever the framing is over there.
And like, is that white label?
I'm sorry.
Is that white label? Like, is that?
It's not really a white label in the sense, you are finally responsible for marketing it, and getting and managing it, and
Yeah.
getting funds into the thing. But it's more like the legal scaffolding, right? So
Yeah.
everything that is required to launch one, there are service providers that do that, and and people have taken advantage of that, and created ETFs left, right, and center. Not that it's a bad thing, but if you are just getting started, it's easy to get carried away, right? Because how different is a pot ETF or a psychedelic ETF different from a biotech ETF? And should you really invest in and there is also this ETF that tracks semiconductors, right? And that has been on fire lately. So should you invest in that? And should you invest in Nasdaq, or should you Nasdaq listed stocks like in QQQ, or should you just buy the S&P 500 index through SPY, right? So it's always a big problem, especially for new investors. So what I've done is, I've taken, I put myself in a position where I was, 20, 25 years ago, just got my job, looking to set aside some cash, and my first instinct was to just go to my 401k. My first job was where I could save anything was in the US. So you'd go to your 401k provider and sort all the funds by latest returns, right? So, and go by the fund that gave the biggest returns over the last 3 years. And now I look at my younger self and make fun of myself, but the thing is, that's what most people do. And if somebody had told me about low cost index investing back then, it would have stuck a chord, I'm sure of it. So what I've done is I've taken the largest ETFs in every major asset class, and the reason why I picked the largest one is because as easy it is to launch ETFs, it's just as easy to close an ETF, right? So if you pick something esoteric, then chances are high that it will just close shop within a couple of years if it is not able to garner enough funds. So you need a fund, you need an ETF that has a fairly large AUM. So that kind of makes sure that it lasts long enough, for your investment horizon. And the second thing is expense ratio. So I gave the example of SPY as an ETF that tracks, the S&P 500 index, but that is actually more expensive than a Vanguard ETF that tracks the same S&P 500 index. And why? Because SPY was the first ETF um, to be launched in the US. And State Street, who is the sponsor of that ETF, markets the shit out of that ETF. Right. So you open your Wall Street Journal, or you switch on CNBC in the US. SPY is everywhere. So S&P 500 is SPY, and it's got a great ticker as well, SPY, right? So who doesn't want to spy? So it's so the whole marketing thing make sure that they can charge a premium for it. But at the end of the day, it's a very generic index. So why should you pay for that, right? So you're better off with a Vanguard ETF. Typically Vanguard, you will find them to be the cheapest, in any asset class. So you're better off with a Vanguard ETF. And secondly, it has to be liquid, right? So some of these things don't trade often. So even though it could be it could have a large size, it may not trade in the in the stock exchange when you actually want to liquidate your portfolio or anything. So buying is the easy part, right? So you can stagger your purchases, but typically when you sell, you sell at a higher velocity than how you purchase them. So you need an exit. So pick ETF that have smaller spreads for trading. So those were my three criteria, and that's how I sort of shrunk the 2,500 ETF universe to 12.
Okay, so now I'm thinking about this in a different way, right? So you're focused more on the fun. The ETFs would say with a large corpus, and you're looking at not team based, but like an index fund, or whether it's bonds, or like world markets, or the US markets. You're looking more from an index level, right? You're not looking at really stock selection, or themes, or that sort of stuff.
Right. So it's more, I think all of them are market cap weighted. There's no stock selection. There's no active management, so to speak.
Yeah. So they're all passive, and they're all
passive and cheap, right? So
yeah,
if you're just
and
starting
there are
out,
no factors.
No factors.
No factors.
So no factors. I thought, let's not bombard people with too much information. Just stick to plain vanilla stuff. So this is like all you need to, I feel like even 12 is overkill, because if you're just getting started, you just need, right? Or maybe even one. You just need a target date fund. But if you're investing in the US from India, maybe that is out of the question, because your broker may not provide you a target date fund that you can buy from your brokerage account. So in that case, you can go with VTI and AGG. So this will basically cover your full equity exposure, and AGG will cover your your fixed income bond exposure. So just do a 60-40 split between VTI and AGG, and that is your starter portfolio, right? The bare minimum. This is where you start.
Right. Okay. So I think when most people want to start, especially U.S. markets and stuff, especially if you're an Indian, what attracts you is tech. It's tech, and it's like I said, psychedelics, and that sort of stuff, because it's because you feel like you're getting something new or something different that you don't have in India itself.
Right, but
Uh,
see, the thing is, those are all, I feel, lottery ticket stocks. So, so the thing is, if you step back from this whole thing and view it from a long enough time horizon, right? So, what exactly is uh, psychedelic? What exactly is um, pot stocks, and how different is it from a generic agriculture industry, right? Because at the end of the day, you're growing something that can be grown freely. If the unlock is because the government has lifted restrictions on growing, marketing, and selling those products, then that applies to everybody. It is not something that is unique to you, as an individual, psychedelic grower, right? So anybody can grow mushrooms. My mom used to grow mushrooms, back in the day. I mean, she was interested in cooking it and eating it, but uh, so it grows everywhere, and all you need is the right seeds and the environment, and it'll grow. So what happens is, you get attracted to these fads, and you don't think through whether there is
yeah.
any moat, whether there is any longevity in those things. And you herd into these, and then you burn your fingers, and then you say, oh, I'm never going to do it. And the worst part is, you don't need to do that. If you have a long enough time horizon, the tanking rupee itself will make sure that it's worth your while. You don't need to buy psychedelics for that. So you just need to be careful. Once you convert it into dollars, you've already taken the conversion hit, right? So you're already down 3%. So why do you want to, further endanger your life savings chasing after all these fads? And these fads, it's all cyclical, right? So because every year I've studied the markets in the US, every year there's something new.
It's just
Yeah. So last year, I keep talking about pot. So there was a Mary Jane ETF, right?
yeah.
Yeah. And before that, for a while it was all lithium, because lithium is used for electric cars, so buy. And then before that it was electric vehicles. Last year it was all EVs, right? So yeah, so like every
And this
year.
year's meme.
Yeah.
This
So, so every year there is some nonsense, they will use to to prop up a specific theme. But the thing is, if you're sitting in India and buying that, you're the ultimate bag holder, right? So because guys who are already pumping it, they hold all these these stocks, and they've sold it to the next bakra, which is probably the US investor. And here comes an Indian investor who's like, hey, I'm here, give me psychedelic stock. You're like, okay, yeah, take it and go. So you're like the last guy in this chain of hot potato, so you don't want to be that guy. Just be careful, and do what is sensible, no matter where you invest. Which is, if you're just starting out, create like a bedrock, right? Like a bulletproof portfolio that um, you're not going to waver from listening to some false stories. And that is just your 60-40 portfolio. No matter where you go, buy your 60 equity and 40 bonds. And these ETFs that I've picked up, it's not some random stuff I pulled out of the air. They're cheap, right? And especially that AGG, it covers pretty much the whole US bond market. And it costs only 4 beeps. Like 4 beeps is like $4 for every $10,000 investment, right?
Yeah, which
So
is crazy. I actually did the math that how much I mean how much does iShares make from that fund, which is just like I think 36 million from like $90 billion. It's just 36 million, which is.
Yeah, I mean, it's a scale game, right? So everybody and his uncle has bought this AGG. So it's part of the core holdings of most retirement portfolios. So, and there's strength in numbers. So just park your money in VTI and AGG if you're just getting started, right? Now, okay, so now with that out of the way, what else is there?
So I think your approach is entirely based on somebody creating a dollar asset for themselves.
Yeah.
So first idea is that first invest overseas. Stop having this homeward that is home bias. I don't think that India, that you can invest or you should invest your entire savings into India. You should diversify and access the international markets. And the first step to do that is just to keep it simple. Just start investing abroad, and start creating the dollar asset. That is more important than choosing what's hot and what's not.
Absolutely. And I'm sure there are people who are reading this. They're going to point out that, oh, there's an S&P 500 index fund in India itself. But let me tell you this: there's only one S&P 500 fund in India. Okay, it is from one issuer, and and he's and you're at the mercy. How much are you going to invest in that one fund? Right. So by the time my investment cross, like say 20 lakhs in a particular fund, I start getting nervous. Like, what if tomorrow this fellow packs up and leaves, or something like what happened to Franklin, happens to this fund. Yeah, sure, it's all index fund and all that, great, but what if there is fraud?
When shit hits the fan.
Yeah, so even though I keep preaching that like buying different funds is not diversification and all that, I do end up owning like 3 or 4 mid-cap funds, because after a bit you get worried that what if this fellow commits fraud and goes away, right? And you've seen what SEBI has done with the manager and all, nothing. So he purposely invested in junk bonds, blew up. He's got his bonus, and over the last 5-6 years none of it is being clawed back, and the investors get tenga, right? So I don't want to be that guy, right? So I don't want to put all my life savings in one fund and hope for the best. So so this is what I would say. Fine, if you were getting started, okay, fine, buy that S&P 500 index fund in India. But beyond the point, ask yourself this question: how much are you going to invest in that fund? There is a limit to it, right? And and where is the size of VTI, which is so I think it's got like some $250 billion in assets, right? And where is this Indian index fund in the US, right? It's an order of magnitude difference of scale. So so my money would beyond a point, I think it makes sense to sort of do this, take money out and put it in these ETFs, rather than depend on one issuer in India to last for such a long time. And we are talking about 30 years, right? 20-30 years.
Yeah. Okay. And the other thing that struck me was there's you mentioned a couple of like emerging markets funds, both on the equity side and on the debt side, which I found to be interesting. So if you had to like allocate a portfolio made of these allocations, how would the allocation be?
Right. So see, I feel, okay, so this is my personal opinion. If you're investing in emerging markets, there's no better emerging market than India. Okay. But it is still an emerging market, right? And it has been emerging since the last 100 years. It has not emerged yet. So I don't see the pressing need to invest in emerging markets through specific ETFs in the US. So the reason is most US companies have a significant amount of their revenue coming in from the rest of the world, and mostly royalty payments from emerging markets, form a large chunk of this as well. And the other problem is, if you take a look, if you consider this from the point of a US investor's point of view, right? Say you're Hindustan Unilever, right? Sorry, scratch that. Say you're Unilever, and you want to show growth. So what do? You tell your investors that I'm going to go to India, I'm going to go to China, I'm going to sell the shit out of my toothpaste, right? Same thing, Colgate is also doing the same thing. Pretty much every other consumer staples and discretionary guys do. So what is happening is they're all coming to India and fighting the same war that they fight in developed markets in India for market share, for mind share, and so on and so forth. And to make matters worse, when they actually repatriate these profits back, they take the currency hit. So, so for lever, they grow like 20%. They've grown 20% in India over the last 5 years or something. It is, it's an awesome thing, selling detergents, right? But when you actually convert that and look at, the growth in dollar terms, it's like 6%. Is it growing faster than the rest of the markets? Sure. But in terms of actual impact to that bottom line, not much, right? So it all sounds fancy when you consider this in local currency terms, like in rupees or pesos or whatever. But when you convert everything to dollars, it doesn't add up to much.
Yeah, I mean, things seem a lot less impressive when you do when you compare things in like in like dollar terms.
Absolutely. And to make matters worse, there is always political risk, right? I didn't mention this explicitly in the article because I didn't want to put it in ink. But the thing is, there's always political risk, especially when it comes to China. So you don't know. They might just steal all your tech tomorrow and say, okay, get out of the country, right? So they can do that, and you have nothing. What are you going to do? Fight a war with them, right? So a lot of this is is possible in emerging markets, especially with China. So I've actually listed a couple of choices of ETFs that does not have this China exposure, right? So one is your plain, so you have your EEM ETF, which is your generic emerging market ETF, but it has a big chunk of investments in Hong Kong and China. So what they did was from that ETF, they just removed China and Hong Kong, right? And they created another ETF called EMXC. It is just EMX China, right? EMXC. But that still doesn't go far enough, because there are a lot of countries that are classified as emerging markets that are actually ruled by dictators and authoritarian rulers, like for example Russia, right? Putin has been the president since like 20 years or whatever, right? So yeah. So do you really want to invest in companies in countries like that? So that's where the FRDM, which basically freedom, right? The Freedom Emerging Market Index, emerging market ETF comes into the picture as well. So so if you are so sure that you want to allocate to to emerging markets from the US, I think an ETF like FRDM is probably the way to go. At least you're not sort of financing dictators indirectly. And but once again, it's sort of like nice to have in my mind, not really something that should that investors should worry too much about allocating to it.
Yeah. Yeah, I think what struck me was that maybe I would have allocated more to China, or to like a China specific fund, maybe because it's perhaps the second most interesting market out there after the US, despite all the like the political tension and stuff. Like it's a different kind of di- diversification. If you want to invest in
We
the
can
world
call
economy.
it political risk diversification. So why do you want to be in a safe space like US when you can go to China and dodge bullets? So,
Yeah. Yeah.
so look, my biggest problem is not that those businesses themselves are not good. It's just that they can all go to zero tomorrow if Panda
Yeah.
Bear
Like,
decides.
yeah, and you've seen that happen like in the last 6 months. Like, things might not have gone to zero, but there's certain just what happened to Alipay and Alibaba in the last 6 8 months, which was like the top. I mean, the share of Alibaba is still up, but the fact that China can do so much fit, and tomorrow things can go very south.
Yeah,
Um,
absolutely. So, all you need is the CEO to insert some, they what do they call them? Princelings, right? Like the sons
yeah,
of all this Politburo guys. So all they need to do is insert some princeling and poof, you're gone. So
yeah, unfortunately, yeah.
yeah. And so yeah, and I don't know, man. I prefer developed markets, over emerging markets, especially if I'm investing through this route. I already have
Yeah.
really big
No,
India exposure. Why would I add more
yeah,
emerging markets?
yeah, yeah. By the way, at some point we should talk about investing in not even frontier markets, like markets that like Iran, which are under
Yeah.
heavy sanction control. Like, like, not, I mean, forget like, or Iraq. Like, we should definitely talk about investing in those markets.
Yeah, I think see, there is money to be made if you have boots on the ground. I don't have any doubts about it. So there have been instances where people have 3x their money in dollar terms investing in Venezuela. Venezuela. And not so far ago, it's like, over the last 3 4 years. Yeah. So they have gone there, they've done the homework, they have made sure that, that Mudoro or whatever, the guy, can't touch their assets. They've taken the money out as well. So it's possible. And there are people I know who are investing in Iraq. Like I think there's one famous manager who goes on podcasts and all that. His thing is invest in Iraq, and
Yeah.
then there are guys doing VC investing in Bangladesh. Like it's got the addressable market of half of West Bengal, but there are people doing VC investing in Bangladesh. So these are, I'm not saying that there are no opportunities, but the thing is, do you really need to squeeze water out of a rock, to meet your investment goals?
Right. No, but I think it will be very interesting for us to cover some of these markets.
Yeah.
Yeah.
So what else we got?
So no, I think I mean, I had a few questions. I have asked you what I had in my mind. Do you have anything more to add?
Yeah. So the other thing is, I'd like to round this off by talking about investing in real estate,
Yeah.
and also commodities. So I think one of the biggest benefits of investing through the US is the access to REITs. So REITs, after India talking about it for like more than a decade, we finally saw like 2 or 3 REITs list, in India. But they're not as popular as as I thought they would be. because at the end of the day, it's you get professional management of commercial real estate, and they have specific rules as to how much of that cash flow can be given out to investors and how much can be reinvested, and how those things are treated from a tax angle. So I was really expecting REITs to sort of take off in India, but it looks like it's still going to be a while before they get popular here. But REITs in the US are extremely popular. So real estate investment trusts, you just raise a bunch of money, go and buy commercial real estate, or even housing, right? So
Or like even storage and stuff.
yeah, storage, warehousing, it's a big market. US is a big market for REITs, and pretty much everything there is is sort of and REITs may not actually own the property outright. They could just buy the bonds that are backed by these properties, so they can just buy CMBS or ABS and keep rolling them over. So so the biggest risk here is obviously interest rate risk, but you have to weigh that against how expensive the equity market is, and whether real estate is cheaper relative to equity markets, and make a call on that. But from a diversification point of view, I think it's an excellent source of diversification, and and most US investors should definitely consider REITs as part of their core holding. So and it generates a ton of income, so you obviously need to be worried about
but there's so what's the yield that you expect? I mean, like historically, what's been the yield compared to the S&P? Is it in between bonds and stocks?
It is sort of between bonds and stocks, and and typically it has generated more returns compared to bonds, and it has not gone down as much as equities, right?
Okay.
And obviously, I'm talking about the big guys, right? There are a lot of specialty REITs which you should not touch with the barge pole, because there'll be like a REIT that backs a small strip mall in rural Kansas, right? So don't go and buy that. You buy a big guy, right? Buy the whole market. Don't buy specialty ones attracted by yields. Obviously 2008 was not a fantastic year for real estate in the US. But if you are willing to sort of say, okay, that was a once in a 1,000-year shitstorm, and probably not going to happen again, then I think you can allocate a big chunk. Maybe I'm talking 10 to 15% of your portfolio into REITs. I think it's a better bet in a in a low rate environment as well. So there's that. And lastly, I think I'd like to talk about commodities, which I hate that space. I hate the word commodity next to investing, right? There's no such thing as commodity investing or investing in commodities. You can trade commodities, right? But investing in it is sort of weird. You can buy gold if you want, because ultimately, if you compare the commodity index without gold to gold, the kind of difficulty involved in first of all, when you say I invest in commodities, it means that somebody is buying commodity futures and rolling them over, right, every month as they expire. So when you compare that, the decay, the roll costs involved in that strategy to just buying an ETF that holds the gold in physical form in a vault somewhere over a period of time, that gold ETF will outperform this, this commodity futures fund. purely because of roll costs. Like every year, a chunk of your funds just decay, right? Because of that. So, so you trade commodities, but if you want to invest in gold as a hedge, you can do that. But for Indian investors, we already have this RBI, sovereign gold bonds, which I think are a much superior alternative to buying a gold ETF, in the US. So if you're an Indian investor, buy the SGBs rather than the gold ETF, and avoid commodities in general. But if you really feel the urge to have an allocation to commodities, then I think I've listed an ETF there, which does a decent job of managing this, this role role issue. Because the problem with this rolling and investing in futures is also the tax implications of it. And in the US, it's a big headache. So you'll have to treat that separately when you declare those returns in India as well. So generally speaking, avoid it. And if you want to invest in gold, buy SGBs. Be done.
Okay.
So I hope that I try to keep this as simple as possible. So this is a good jumping off point. And if you want a more active sort of strategy, then you guys obviously have freefloat.us, right? So you know that freefloat.us has like a dozen strategies that use all these ETFs that are available there, and also does a fair amount of algo investing. So and they have performed well. We have like factor rotation strategies and so on. All use ETFs, and they've performed well. They've beaten their benchmarks. So if you are looking for something over and above this, once you've already done this, your basic allocation, and you want to add some alpha to your portfolio, that's always there. freefloat.us. So have a look and let us know. But if you want to get started, this is the place. 12 ETFs are all that you need to know about, and maybe just invest in 2 of them.
Sounds very nice.
Cool. So so anything else you want to add, Kishan? Like how are you going about this? What have you invested in? Don't tell me psychedelic ETFs.
No, not psychedelics, but I own a NASDAQ fund.
Okay.
And a couple of momentum based funds.
Okay.
And apart from that, just some stocks. So so I'm not the kind of guy who invests in who just wants to invest in S&P 500 because I think I'm smarter. But but that's not always true. But I still believe that those mistakes I made were just were just things that I was just overconfident or thought the wrong way. Nothing to do. I would never think that the S&P 500 is better than me. I always think that I can beat it.
Right. So I don't know. My portfolio is sort of like a barbell. So I have MTOM, which is the US momentum ETF. Then I have IMTM, which is developed market momentum ETF, and I have VO, which is the Vanguard mid cap US ETF. So my theory behind, and then the other 25% is BRKB, which is Berkshire Hathaway, Warren Buffett's fund. So I allocated towards this, I think, a few years ago when IMTM came back, got into the picture. That's when I rebalanced last. So I've been holding it for a while now.
Oh.
And the whole thing is, it's like a barbell. So I have momentum on one side, and I'm betting on America on the other side. So I'm very happy with it.
You won't believe what my largest US exposure is in, though.
Let me guess. So this is going to be GameStop.
No, Dropbox.
Which one did you say?
Dropbox.
Dropbox. Okay. I don't know, man.
Yeah.
I mean, we can debate about this for forever.
Yeah.
Because
Before Dropbox, it was Twitter, and Twitter was extremely frustrating. I held it for 2 years.
I think even Dropbox is going to be frustrating for you. I think it's a very generic service. So I mean, I'm a user of Dropbox. Don't get me wrong. I like that. But and I think back in the day, for everybody you invited, they used to give you free
Yeah, 2
storage.
GB.
So I have like 1 terabyte of storage. Or 1 terabyte or 100 GB. I forgot what it was. I
Yeah,
have some
1 terabyte would
insane.
be a lot.
Okay, so maybe 100 GB because I have like some insane amount of Dropbox space. I never paid for it, and then they finally stopped doing that. So
Yeah. I've held Dropbox for a year, and I mean, the rest of the market is flying, and Dropbox is like, it's like holding ITC. That's how I feel. I mean, it's better than ITC, but I feel that's like holding ITC.
Yeah, I'm not a big fan of this sort of individual stock picking. So I just prefer to buy like a basket 20-25 stocks. I know that I'll probably sell something just before it starts rallying. I don't want to even get into that. So and honestly, I've made money in some fairly junky stocks, both in India and the US, purely because of algo driven stuff.
Yeah.
Like people keep talking about how they lost money investing in Vakrangi and DHFL and all that, but my momentum
you got
portfolio
out
has
and you
held
got
all
in.
of them, and I've made money in all of them. So I
Yeah.
have no regrets. I held them for like a week or something max, but whatever. So the thing is, my take is this: don't pick individual stocks. And the worst thing is, people picking stocks in the US sitting in India. I feel that is, that's like too much, right? If I have to pick stocks, I'll probably buy only stocks which have like a headquarters in Bangalore, so that I can go and knock on their door and see what is going on. Right? If I had to ever pick stocks,
Like,
that's what I would do. Only Bangalore.
Yeah. Yeah. Like like cognizant and make my trip and stuff.
Yeah. Absolutely. So I don't know, man. I don't know how people do that kind of stuff. Like they have like such a big pieces. Macro, micro, competitive analysis, this, that, and then finally they go and
Dropbox. So Dropbox, I did a complete I worked on it for like 3 days. It's almost like I convinced myself like this is the next FANG stock,
Yeah.
Yeah.
I know, man. I know.
Yeah.
So I hope people give free float a look, because we avoid doing all this stuff. It's just pure algo.
It's so funny. Before I got into algo trading in India, I used to pick stocks, and there were hits and misses. But I went completely the algo way when I did the when I got into it. And it's been like 8-9 years, and I really picked stocks in India anymore. And the US, that whole habit went. My old habit went to the US, and now maybe when the US will go the algo way, and then I'll start looking at Iran.
So this stock is actually owned by the Pasha's sons, who is working in the National Guard. So
Yeah.
Man. So I guess we should bring this to a close. If you have any questions, do drop us a note. On the comments. We hope to hear from you. Until next week, stay safe and do check out freefloat.us.